Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. Shares of Borax are rallying after news that Brookfield and Quebec pension fund, the Caisse de dépôt, are teaming up to buy the renewable energy firm. The deal is valued at $9 billion, including debt, and shareholders will get a little more than $37 in cash per share. That represents an almost 32% premium. After the deal, the company will operate independently and plans to accelerate its 2030 strategic plan. And we'll get more insight on this deal when we speak with CEO Patrick DeCostra on the close today at 3:40 p.m. Eastern. Shares of AG Growth International are down right now and down considerably. Look at that. That number isn't wrong. 32.5%. The company posted a steep decline in profit in its latest quarter, cut its leadership team in half, and also suspended its dividend. Some analysts note the results might cripple the company's growth after a turbulent 2025. AG has been grappling with accounting issues around its Brazilian operations, activist pressure, and sales headwinds. Shares of ARM Holdings are surging after the semiconductor company said it would sell its own chips for the first time. It's up 17% right now. The move is expected to generate about $25 billion US within 5 years. Meta will be the first major customer for the UK-based company. Until now, ARM's main business had been to license its technology to semiconductor makers. And taking a look at the markets right now, and another up day for the TSX. All the indices are in the green except for consumer staples, and it's ever so slightly off, but otherwise a good day all around, up by 1.31%. And the U.S. markets, similar situation. The rally continues. S&P 500 up over 6,600, up by 0.85%. The Dow by 0.88%. And the NASDAQ back above 22,000. It's up 1.25%. Well, shares of Borax are soaring today after news that Brookfield and the Quebec pension fund are teaming up to buy the renewable energy firm. Let's get more on this from Teresa Schutt, Chief Investment Officer at Harborfront Wealth Management. Teresa, thanks as always for joining us.
Thanks as always for having me. Good morning.
Yeah, it's a good morning for Borax right now. Your thoughts on the deal?
Yeah, absolutely. So I think this is essentially a win-win for both sides. As we know, Borax builds and operates renewable energy across Canada, the US, France, and the UK. They're highly diversified, wind, solar, and now energy storage. They've got installed capacity of nearly 3.8K megawatts. And it's been kind of the story of why certain companies really want to go private. The stock is trading at about 50% of its 2021 peak. And that was really a time where we saw significant tailwinds for the renewable sector in the run up to Biden's presidency. And then during that presidency, a lot of installations were built. But we did see a lot of volatility in the sector as we had this backdrop of kind of inflation and geopolitical issues. And then, of course, with Trump's return to the White House, there was a very deep policy shift, in fact, to really slow the growth of energy stock, or clean energy, which weighed on that stock. And so, in the meantime, the companies continued to perform. And there are a number of really attractive features to this business. So, number one, you have cash flow stability. With many of these infrastructure, sector companies, most of the revenue is guaranteed. It's secured through these long-term, fit contracts, power purchase agreements, and that offers a lot of stability against market volatility. As well, they have a very aggressive growth strategy. They really increase, their aim is to increase installed capacity, I think to something like 7 gigawatts by 2030, and they become really a top presence. So they've increased their capacity, I think, over 50% in the last 5 years. And then finally, I think that, the really kind of attractive narrative to this company is their commitment to battery storage. Which will be, a game changer to really help them mitigate intermittent power. So, really by going private through this deal, it resolves what many see as a valuation disconnect, where public markets didn't really reflect, the company's quality asset portfolio and their growth pipeline. And they're also securing access to long-term capital with partners that are well known. And obviously, as we know, K's already had a 15% stake in the business. So I think this is a pretty exciting deal. I think really, even you can talk about AI and data center build out. Renewables got a big role to play there. So I think this is good development for all parties.
And bigger picture, there's been concern about companies going private in Canada. This is another one. Concerns that might accelerate that, or where do you think this is heading?
I think it's interesting, particularly for businesses that operate more in what would be traditionally kind of private markets, where much of the value of the business relates really to the underlying performance of that asset, whether it's real estate, whether it's an infrastructure project or business like a private equity business. And I think most of those businesses will perform regardless sometimes of market swings. And so to take that noise away so that they can have, more consistent or patient source of capital, which is institutional capital, I think that can really help businesses grow and really focus on their business plans.
And bigger picture, the markets are having a good week. Is that a lot of optimism? And do you think that there's good reason for the optimism?
Yeah, I'm mixed. I really think the markets are clinging to the hope that there's a possible end to the war. We've obviously been talking about the 15-point proposal that, the U.S. has provided to Iran. However, Iran hasn't confirmed that they've received it. And, they continue to publicly dismiss any diplomatic solution. And many of the points in the plan have really been non-starters for Iran even before the war began. They're asking for, reopening the strait, of course, restrictions on, their support for armed groups, dismantling of the nuclear program. In the meantime, Iran wants, full, compensation for the war. They want to continue to run the strait and actually charge tolls. So they're very far apart. So I think this is a bit premature. And I do think that, the American public just doesn't have the patience or appetite for this type of conflict, where for Iran, maybe the longer the conflict lasts, the better. So I don't think we're quite there yet. I think this is maybe too much optimism. I think it's less pragmatic, and I think we really have to see the two sides come closer together and a true ceasefire before I think we really know where we're going.
And of course, this energy shock has been good for energy companies here in Canada. Even if this is settled, do you see that carrying on, that momentum?
In terms of the impact on other sectors and inflation?
And with it, obviously the negative side, but the positive side to Canada, this has raised a lot of eyebrows and opened up a lot of eyes that maybe people want a little more reliable source of oil. Yeah. Do you think that will carry through and they'll be looking more at Canada?
I certainly think so. I think we've seen, obviously this take precedence in the headlines, but, I think, maybe something that someone has missed in the headlines also, as well, is that, this memorandum of understanding that was signed between Carney and Alberta Premier Smith is now reaching its first deadline of April 1, and we're nowhere near meeting it. So I think that needs to kind of get back as part of the narrative. Energy security has become even more important. Now Alberta is talking about trying to, maybe collaborate with the U.S. on their own to build some pipelines south of the border. But I think there's also, some positive benefits to our upcoming negotiations with CUSMA. Americans are facing much higher prices at the pump. U.S. midterm elections are approaching, so there's a lot of concern. And the energy system between the U.S. and Canada, it didn't develop just because we had volume and oil, as well as proximity. It really formed because of structural compatibility. So, 70% of the U.S. refining system, particularly in the Midwest and along the Gulf Coast, was built to process heavy sulfur-rich crude. And that's really what Canadian oil sands production is. And so that fits that requirement. So, I think, energy security has become obviously a huge concern. And, Canada having that political stability, rule of law, obviously environmental accountability. This is, I would say, the real energy superpower that Canada holds. And this should be a big reminder to the U.S. that, they still import 60% of their oil from Canada. We're a good partner to have. So, and I think the rest of, the U.S. is maybe starting to see that. So I think this provides some good tailwinds for those negotiations coming forward.
All right, let's go down back to the negative side if this does maybe carry on. Inflation fears, possible global recession, and rates. Where do you see rates going?
Yeah, I think this is really interesting. I think we all know that, officially the Fed is still focused on cutting interest rates, but I don't think they may have a choice anymore. I think the vibes have officially changed. Their next move maybe to raise rates, as soon as September. We see the market already pricing that in. Really a one-off rise in price, really only causes lasting inflation if it doesn't work its way or it works its way into kind of prices and wages. So to the extent that this continues, and I don't think we're over yet, we're going to start to see that seep in to materials, to input costs. Eventually I think we'll see maybe some of that wage pressure. So I really think, the Fed is at a really difficult position right now. And we're seeing that in bond yields as well, particularly in the 2-year Treasury. We've seen a lot of volatility. We saw it climb above 4%, the highest it's been since July. And that's pivotal because, this is the year where we have a lot of, U.S. marketable securities coming due for maturity. So roughly 10 trillion in debt maturing, and refinancing costs that are really sensitive, obviously, to the level of interest rates. And the previous administration, really relied on more short-term debt maturities. So there's a move to try to extend it out to 10-year. So a lot of people are watching the 10-year. And I think that's going to be, kind of a key to really how the bond market is viewing this conflict and viewing inflation. The equity market is one thing, but the bond market, I think, they're the true kind of observers of what they view as kind of the risks of inflation. In terms of recession, I think, this is obviously starting to hit Europe. They're talking about rate cuts, which will jeopardize their recovery. And Asia, of course, is getting really hurt by these higher costs. We're seeing certain airlines now get grounded because they just can't afford the price of gas. So that could really disrupt business and obviously economic growth. We've seen projections for, at least in Europe, I think the forecast for growth this year has gone from 1.1% to 0.8%.
All right.
And that's just over 30 days. So, I think people are seeing that it's not going away, and it's already started to impact people's inflation expectations.
Okay, we have to wrap it up there, Teresa, but thank you as always for joining us.
Thank you for having me.
Teresa Schutt is Chief Investment Officer at Harborfront Wealth Management. Coming up, the price of oil dropped this morning as markets reacted to news of a potential end of the war in Iran. We'll have more on that after this. The price of oil still under pressure after the United States reportedly drafted a 15-point peace plan in hopes of ending the war with Iran. Let's get more now from Rory Johnston, founder of The Commodity Context. Rory, thanks very much for joining us.
Thanks for having me.
Okay, do we have optimism today? Should we have optimism? Or I'll leave it at or.
We have a lot of optimism in the market. We've had it for a while now. I would say that one thing we know about this oil market is that the White House and the Trump administration has been extremely put a lot of effort, let's say, into talking down and jawboning the price of oil lower. That's the main point of pressure on the administration to end this war. So less oil price kind of elevation means less pressure. And they've been very effective at convincing the market that this thing is about to end soon, that these negotiations into this weekend will wrap, and that come Monday, things will be beginning to unwind, and that presumably flow through the Strait of Hormuz will begin to resume again. But as today, we still effectively have a shuttered Strait of Hormuz. The oil market continues to hemorrhage roughly 15 million barrels of oil every day that remains closed, and that hasn't changed. So every oil analyst is basically like, okay, waiting for the actual conclusion, but markets attempting to kind of look forward. And I think an analyst this morning referred to it as irrational optimism, that the alternative to the war ending and the Strait of Hormuz reopening is just so unthinkable that they're preferring to kind of err on the side of optimism.
Now, is it unthinkable that if this war drags on? I mean, I was just looking at some of your numbers. Instead of the 20 million that people are talking about, when they get it ramped up, we'll still be short 13 million a day, which is still a huge chunk. But they are managing to reroute some. Would it be, though, the absolute end of days if the war drags on?
Yeah, so just to kind of go through some of those numbers, out of the total of 20 million barrels a day that regularly pass through the Strait of Hormuz, at least prior to the war, we've been able to reroute some of those barrels. I think on our most optimistic assumption, you could probably get that down to 13 between Iran still exporting its crude and the Saudi East-West pipeline and some Emirati flow to Fujairah. But all of those are still kind of underperforming. So I'd say right now we're probably at about 15. And SPR releases, Russian and Iranian oil and water, which the Treasury has removed sanctions on, will help that. But to your question of will this be the end of days if the Strait does not resume? Yes. The oil market cannot fill a hole that large. And we're talking about a similar degree of demand destruction that we experienced in the depths of COVID in March and April of 2020. So we're talking not just recessionary, but depressionary if this continues, which is why from the beginning, I have thought that Trump would eventually pull back here, which is what we think we're seeing, and the market shares that view. But as of yet, there's still many, many questions as to how this resolves and how either sides can find kind of that squishy, acceptable middle ground between their positions to get the Strait reopened. And during that time, Iran has no incentive to open the Strait while they're negotiating, because that remains their key source of leverage.
And that is the card they hold. But who does it feel? Is that the big one? Is that they can control the Strait? Because we don't really know what's unfolding in Iran, because we're getting conflicting reports out of there.
Yep.
So how do you interpret what's being said from different sources, and just how bad is it in Iran?
So I think that, obviously Iran is under concerted attack. And I think that at the end of the day, the Iranian regime's primary goal is survival here. But I think that they had prepared for an extensive, prolonged campaign. They've been preparing for this for decades. And I think that while ultimately the United States and Israel would succeed in overcoming that regime with enough time, we go back to that point about this is fundamentally a crisis of lost time. And every day the Strait remains closed, more and more pressure builds in oil markets and refined product markets, particularly in Asia. And that is that kind of forcing mechanism. So while I think that they do want to survive, they have, I think, more strategic patience here than the White House can have, because back to that point about the jawboning, that can only work so long to keep prices lower until the physical market realities come in and kind of force things higher. All
right, let's quickly look at the two scenarios. And the first one, on the weekend, they sign a deal. Everybody's peace, love, and understanding. How long does it take to get back to normal in the Gulf?
I think you're probably talking 2 to 3 months minimum to kind of unwind the knotted supply chains and tanker bottle ups that you've seen emerge. And yesterday we saw the CEO of the Kuwaiti Petroleum Corporation, the National Petroleum Corporation of Kuwait, talk about it being 3 to 4 months to get the shut-in fields started up again. And as of this morning, we're sitting at somewhere in the ballpark of 10 million barrels a day. This is not just blocked exports. This is actually shut-in production that we're losing from the market. And if held through the end of the month, that's 200 million barrels of oil that were never produced. So even in the most optimistic scenario, we exit this, things resume full tilt through Hormuz on Monday. Even that scenario, we're going to exit this in a much tighter environment than we entered it, given that loss of production that's going to be drained from inventories.
And if the war flares back up again, we already know Asia, they're talking about rationing. And even in Europe now, some CEOs came forward and said, look, we're in a situation if this goes on.
Yeah, if this doesn't end, then I think that, this may be the White House's last chance at kind of attempting to talk this down through verbal intervention alone. And we're going to need to see a lot more action and a lot more realized kind of consequences from any kind of wind down for this to work. And if this gets worse, again, the crisis continues. It's a crisis of time. And if it resumes in any real way, then you also have that stepwise risk to the upside of further facility tax like we saw last week.
And now, if this continues, do countries like, say, Canada, Venezuela, do they start looking more appealing as sources?
I think overall, even kind of if this ended tomorrow, I think, countries not in the Gulf are going to look more attractive in terms of a long-term energy security perspective. But I think in the scenario that, the war does not end, then I think Canada and other major producers do benefit from that price uplift. But eventually, too much price uplift is a bad thing, and then we start to feel the pain of the recessionary and, again, potentially depressionary consequences on the other side of this. And I think long term, it's in no one's interest to keep the strait closed.
And you say depressionary. That's a strong word.
It's a strong word.
It's 100 years pretty much since we've used that. What makes you think that?
And again, this is just where I go back to this. If we're talking about destroying the level of demand that we destroyed during COVID, which at the time, not a car on the road, not a plane in the sky. You and I were locked in our houses. That's the kind of retrenchment in global demand that we would need to see. And we couldn't rely on global lockdowns. We would need to rely on price incentives alone. And that would be debilitating across virtually every supply chain. And it would force dramatic lifestyle changes across the world, particularly for the global south, which will feel this in terms of actual physical shortages. And the global north, we will feel this as a massive and rapid erosion of our disposable income, given kind of that rising fuel price, which will hit us like a tax.
All right. On that happy note, we have to wrap up, Rory. Let's hope we don't get to that. But thank you for joining us.
I hope I'm wrong too. Have a great day.
Cheers, Rory. Rory Johnston, founder of the Commodity Context. Well, coming up, today's market drivers with Bloomberg's Monique Molina. Time to take a look at today's market movers, and we are joined by Bloomberg Equities reporter Monique Molina. And Monique, thanks as always for joining us. ARM Holdings setting up a new shop, I should say, and people are liking it.
Yes, so ARM, their shares are up today after they announced that they're going to be making and selling their own chips. Previously, they had just been licensing their technology to other companies, but they're now intending to get into the business of direct sales themselves. And they're anticipating that in 5 years' time, this could generate $15 billion of annual revenue from doing this move. So this is something analysts are really positive on. The company also gave an ambitious sales forecast, saying also in 5 years' time, they could be doing $25 billion a year in sales, which would be quite an increase from their current sales. So this is just bringing a lot of optimism to the space and really bringing up hopes that this transition is going to really help this company move forward and continue to grow.
All right. And let's talk about the impact, everything in the Middle East, where it's having an impact. Gold stocks, what's going on there?
Yes, so the gold stocks, they are trading higher today after the price of gold rose on the news that the U.S. President Donald Trump did submit a ceasefire plan to Iran. While Iran has rejected that plan, people still see it as positive, the fact that the U.S. is looking for a ceasefire, that maybe talks can now progress to kind of come to a conclusion of this war. And that's really positive for the gold names because they've really been pressured as investors are becoming more cautious of the economic outlook and also fears of inflation, which could push out interest rate cuts. So getting things back to normal and having an end to this war would be really positive for those gold names.
Okay, and energy stocks. I took a quick look at Chevron. Oh no, now it's back down again from what I'm seeing. The numbers I'm seeing. I imagine they're having a rocky day.
Yes, the energy stocks, they are having a rocky day. Many of them are down and some of them are kind of fluctuating as investors are really trying to parse out what's going to happen. We've seen oil prices fall today and that's what's pressuring those energy shares on that ceasefire proposal. But like I mentioned, for now, Iran is saying that they are not accepting this proposal. So there's still a lot of uncertainty in the market around when an end to this war is actually going to happen. But in the meantime, oil prices are being pressured as people think maybe it's sooner than potentially previously thought.
And then crypto, where are we at with crypto? It's been, I mean, it usually is a roller coaster, but it seems like it's been a little bit more of one lately.
Yes, crypto's definitely been on a roller coaster since the start of the war. We are seeing the stocks higher today. We saw Bitcoin and Ether, two of the largest tokens in the crypto space, climb higher, and that's really pushing some of these exchange and miner names higher. And a lot of this is due to the fact that crypto has been kind of trading similar to gold since the start of the war. We're seeing that when there's hopes that the conflict might be coming soon to an end, that the crypto stocks are doing better, and when there's thoughts that the conflict is going to continue further or escalate, that the crypto stocks are doing worse. So these hopes of a potential ceasefire are helping the crypto stocks, and part of this is just due to investor risk sentiment. A war creates a lot of uncertainty. It's putting a lot of pressure on different firms. So then people are choosing to reduce risk in other areas that typically have more risk. So crypto being one of them. So similar to the mining stocks, it's on hopes that maybe the war will be coming to an end soon.
All right, we'll leave it there. Monique, thanks as always. Bloomberg's Monique Malima. When we come back, Canadian farmland values continue to rise, especially in the prairies. We'll get more details after the break. Shares of Borax are sharply higher, up 11%, 11.25%. Brookfield Asset Management and Quebec pension fund La Caisse are partnering to buy the Quebec-based power producer. The acquisition valued at $9 billion, including debt. Borax shareholders will get a little more than $37 in cash per share, nearly 32% premium. Once the deal closes, Borax says it will operate independently and plans to accelerate its 2030 strategic plan. And we'll learn more about the deal when we speak with the CEO, Patrick DeCostra, today on The Close. OpenAI is going to discontinue its Sora AI video generator. The company is also winding down its partnership with Disney, which was centered on the app. Disney had previously agreed to license its iconic characters to OpenAI for use on Sora and take a $1 billion stake in the startup. The move to shutter Sora coincides with a push by OpenAI to streamline its product lineup. GameStop recorded lower revenue and profit for the fourth quarter, with sales of hardware, accessories, and software seeing a decline. The company's stockpile of cryptocurrency also dropped in value. On the upside, revenue from collectibles rose 35% compared to the year before. Results come after GameStop said it's planning a major acquisition of a public company to increase its value. Well, trade uncertainty and higher input costs are not holding back the rise in Canadian farmland values, according to a new report by the Crown Corporation Farm Credit Canada. This trend has now continued for more than 3 decades, but profitability could be challenged by ongoing events in the Middle East. For a more detailed look at Canada's farmland market, covering more than 93 million acres and crops, is Justin Shepherd, senior economist at Farm Credit Canada. Justin, thanks very much for joining us.
Yeah, good morning, Roger.
It's quite the run. I mean, we look at other forms of real estate. Obviously, this is different than them, but still, 3 decades of increase in values. What is driving that, and where's the money coming from for it?
Yeah, when we look at Canada, we've seen those increases over the last 3 decades. But when we actually start digging down into both provinces and then the smaller regions that make up for it, we see a lot more variability. So while we saw farmland grow 9.3% again in 2025, the exact same amount as 2024, different regions and different provinces had very different outcomes. Some remained strong, especially in the prairies, but some areas like central Canada into Ontario and Quebec, they saw their growth slow in those areas.
And what was the difference between those areas? Why the discrepancy? And at BC, I think, was even negative last year.
Yeah, we saw a slight decline in BC, but that's after strong growth last year, so some up and down in British Columbia. When we look at the prairie land market, there's fairly limited amounts of land that come up for sale each year. It tends to be a supply issue. And then on the demand side, we've still seen producers who have strong risk management, who are looking to expand. There's still good opportunities for those producers to grow in those opportunities. In Ontario, we had stronger growth 3-4 years ago. So that growth has definitely slowed a little bit, but we're still seeing positive growth there overall.
And was it, I mean, with this 3-decade, I'm still fascinated by the pretty much continuous growth. Was it undervalued years ago and now they're just slowly been catching up, or are people realizing there's a lot of money in this?
Yeah, 30 years ago, we were coming out of the 1980s, which was really challenging for agriculture. The early 90s is really where that land market kind of hit a bottom. And since then, we've seen farmland values grow over very consistently. Part of that is due to production methods for farmers embracing things like zero-till, which allowed them to go away from summer fallow, which meant that 1 out of 2 acres used to not be farmed every year. So now with new technologies, producers are able to produce a crop every year. We've also had strong markets, especially since the early 2000s, with the United States Renewable Fuels Standard caused some of that growth. So it's been a very gradual run-up, but it has been pretty consistent.
Now, this year, obviously, there are some challenges with fertilizer and fuel. What kind of a pressure will those put on?
Yeah, definitely. Producers are concerned as we are getting close to planting the crop in parts of Canada, maybe 6 weeks in others. So some producers would have locked in input costs last fall, so they probably have a slightly different view on the year ahead. But for all producers looking at things like fuel, where maybe it's not as easy to lock in, those producers are looking at higher costs through the season. So there is concern. We're seeing tighter margins across grain and oilseed across the country. It doesn't matter really the region. We are seeing tighter margins, and we were expecting tighter margins prior to the conflict in the Middle East expanding. So ultimately, producers are very good business people. They are dealing with, they're seeing a little bit higher commodity prices as an output as well. So things like canola are up over the last month, but definitely some concern over where input prices go.
And who's buying the land? Do we know? I mean, are we seeing the small farmers disappearing with these prices?
Yeah, we don't have a perfect data set coast to coast. Each province is slightly different, but in general, we still see the producer being the marginal buyer of farmland in Canada. They tend to be the ones who have the most incentive or ability to adopt or take on slightly larger acreage. So we still see the vast majority of farmland being bought by farmers in that local area.
Are we starting to see REITs show up and wanting to buy them?
Can you repeat that, please?
REITs, real estate investment trusts, are we starting to see those show up to buy land too?
Each province has its own rule on what it allows for investments, whether it's foreign or even domestic. But there is always interest from different from groups like that who are interested in looking at farmland, which has been a pretty stable investment for the last 3 decades.
And is there any more room for growth land-wise in Canada? Are we pretty much farmed out? In that we've taken all the arable land that we have available?
It's pretty small at this point. When we see additional acres coming into production over the last 20 years, we have increased our total cropland, at least according to the Canadian census. But some of that land is coming from things like summer fallow or perhaps some other area, other region of cropping. So in general, we've seen it be pretty flat over time.
So it's flat farmland. Sorry, there was a joke in. So it's pretty much then science is what's next for this improving crop yields. Is Canada leading the way when it comes to that?
Canada has very strong growth and has had very good productivity over the last 30 years. Productivity, like many sectors, has slowed. But compared to some of our main competitors south of the border, we'd be pretty similar. But a lot of productivity growth is coming from competitors in, say, Brazil or Argentina right now.
Okay, we have to wrap it up there. But Justin, thank you very much for joining us.
Yep, thanks for having me.
Justin Shepherd is Senior Economist at Farm Credit Canada. Coming up, our conversation with the CEO of GoFundMe. We'll find out just how generous Canadians are when we come back. Just how generous are Canadians? According to GoFundMe, in the last 5 years alone, over $1 billion Canadian has been raised through the platform to support Canadian causes. For more, we were joined earlier by Tim Cuddigan, CEO of GoFundMe.
started with our two co-founders thinking, wouldn't it be great for people to help each other in all kinds of different ways? And originally they anticipated it being people, getting their friends to help them go on a trip or maybe get married. And it turned into something much more very quickly, where people have started helping each other for all kinds of things in all aspects of their lives. And we started here in 2013. It was our first international market, and Canadians have adopted. I think we've up to nearly 20% of Canadians have used GoFundMe, which is pretty incredible.
Canada was your first international market.
Yes, it was 2013.
Why?
It was a natural, it's right next door.
Yeah.
There's some real similarities in the way people interact.
Yeah.
It made a lot of sense, and it's been a really, really important country for us ever since.
Do you know since then how much money has been raised overall?
I think it's approaching $2 billion, but it has accelerated over the last 5 years. So as you mentioned, $1 billion just in the last 5 years. To give you a sense of that, that's a big number. It's hard to relate to.
Yeah, it's hard to wrap your head around.
Over 6,000 times a day, Canadians are supporting each other on GoFundMe. 6,000 times a day.
I don't know if you have the numbers, but just in comparison to other countries, does that show just how generous Canadians are?
Canada's really up there. It's a top 5 country. We're in 20 countries around the world, and so really up there in terms of supporting each other.
And as you say, GoFundMe is used, people use it for so many different ways to raise money for different things. Where is GoFundMe seeing the fastest growth? Personal causes, community needs, or larger institutional fundraising? Is there one that
So we're
out?
still mainly seeing individual fundraisers. So a couple of categories that have actually grown pretty quickly is people fundraising for their own business. So I was just with a customer yesterday, Mabel's Fables. It's a beloved bookstore here in Toronto, needed to move, had some extra expenses, raised $130,000 and made that move a lot easier for them. So it can be individuals for their own situation, it can be for the business they operate, or it can be for community projects. So it really crosses the gamut. It's pretty amazing to see what people are doing.
Yeah. Is there some ways that the company is kind of trying to evolve, maybe new partnerships, or how has GoFundMe evolved even since it began?
Yeah, I mean, the principal thing that we do is we try and make it easier for people to ask for help. So we've introduced a lot of technology. In fact, just last week, we introduced a new AI-powered coach so that every single person who's thinking about starting a GoFundMe can have help crafting their fundraiser, setting their goal, managing their goal, sharing all of the steps you need. Because fundraising is an unfamiliar thing for most people starting a GoFundMe. Many of them have never done a fundraiser before, and there's actually a lot of things you need to do to make it successful. So kind of holding their hand with all of the experience that we've gathered, because we've had over 40 billion US raised since we've been running the platform.
Wow.
So taking that experience and giving it to people in a scalable way.
And as you say, some people just find it difficult to ask for help, right? Most people do.
We all do, is the reality.
Yeah.
I mean, everywhere I've gone in the world, everyone I've spoken to is it was hard for me to do this, but once I did it, to see that help flowing in was so powerful. And it's not just the money. The money is super helpful, but it's the psychological and emotional support from friends, family, community that really lifts people up in a very powerful way.
There's so much talk these days of different companies starting to integrate AI into how they operate. How is GoFundMe integrating AI into?
Yeah, so we started at the feature level. So for example, people find it hard to decide, should I ask for $1,000, $2,000, $3,000? So as they wrote their fundraiser, they could opt into our smart goal technology, which says, hey, based on what you're fundraising for, here's the goal, and here's how to manage it, because you can change the goal over time. So that and other features have already been used 80 million times around the world. And then we integrated that, as I mentioned, a couple of weeks ago, into a more holistic coach that holds your hand through the whole journey. But the interesting thing about AI is there is also a lot of concern about AI. Is it going to sort of replace us? And the interesting thing about what we do is helping one another is inherently human. That's not substitutable. But the process of doing that, we can help a lot with technology. So making an ever more powerful tool that allows people to understand the steps they need to take and make it a little bit easier. That's what we're doing. And it's working incredibly well.
And Lindsay was speaking with Tim Cadigan, CEO of GoFundMe. Coming up, historically, private markets have had a reputation for stability, but that story may be changing. We'll break down what's shifting when we come back. On the surface, private assets can appear to be the steadier corner of the market, a place investors look to for consistency. But that narrative may be shifting. For more, we sat down with Colin Stewart, CEO and portfolio manager at J.C. Clark, to discuss what's changing in that space.
This has been an asset class or category that's been very, very popular with investors for the last decade. And, in some cases for good reason. I think the returns of some of these private real estate, private equity, private credit funds have been quite strong. There's also been a secondary, though, view that they're less volatile and safer than public markets, which I think is now being proven to be incorrect. And so, we've seen this before. As we talked about earlier, Roger, like anytime you have a lot of investor capital flow into a particular category or asset class, returns usually get compressed. And we've had a lot of investor capital flow in. Those investment managers are forced to put that money to work. They're probably chasing lesser and lesser opportunities, paying more premium valuations, competing for return, and that dwindles down the return. And I think it creates risk because the 20th deal done is never as good as the first or second deal. So I think that's what we're seeing. And the other issue is that these have sort of had this safe haven reputation among investors in Canada and the U.S. that they think, well, these funds are very stable, they don't go down. But that really is more to do with the pricing mechanism and how those funds are valued. In other words, in public equity strategies, like we run at J.C. Clark, you see the pricing every single day. The stocks go up and down, and the price is what the price is. The NAV is struck. Whereas private funds, they're valued perhaps once a month, once a year, and there's a lot of subjectivity and discretion because we don't really know what those asset prices are.
Is there any regulatory on that? Like, do they have to?
Yeah, I mean, there are rules. Obviously, those funds are audited. The auditors have a process they follow. But I mean, inherently, if something isn't publicly traded, there's maybe a discounted cash flow analysis done. But that you can do a discounted cash flow analysis on a company in the public market, and it says it's worth 20, and it's trading at 12. So the transparency of the daily public market pricing is something that has been lacking in those private funds. So there are really two issues now. Is we've seen a lot of these funds gate or freeze redemptions, and so that's been I think a shock to some investors who perhaps got into these funds and didn't realize that they could be gated. In other words, they can't now redeem and get their money back. And we're seeing that happen in the U.S. I think just yesterday, Apollo announced that they were gating redemptions or limiting redemptions on one of their funds. We've seen BlackRock do it. A lot of these large U.S. Private equity firms are doing this, and it's causing a bit of a panic among investors. Then there's the secondary question of if an investor's most recent statement says their investment the NAV on the fund is $100, well, is it really $100? And can we trust those NAVs? And we've seen a few instances where one day the private equity fund or the private credit fund says NAV's 100, and the next day they say it's 80. So there's been a huge markdown. So the question is, are the underlying assets actually worth what they're valued at in the investor statements? And so, we'll see how that plays out, but I think it's a real risk for investors here.
What led to this initially, this recent surge of going this way?
Sorry, you mean the popularity?
Popularity, yeah.
Yeah, I mean, I think it was a sort of democratization play. In other words, private assets 10 or 15 years ago were, only super high net worth investors or pension funds could get into them, but a lot of funds started and provided more access to retail investors, and the average investor was able to access these strategies and thought, well, this is a great opportunity and I can get in, and perhaps they didn't really understand what they were getting into. And you can't paint the whole sector with one brush. I mean, there are obviously some very well run private credit, private real estate, private equity funds, but I just think there's been such a rush of capital. Anytime we see that, everyone thinks, well, all these funds are great, and they don't really understand what they're getting into. It's more difficult because these funds are less transparent, more opaque, hard to understand what they're buying, what those underlying assets are worth, how to value them, what the terms of the fund are. Can I get in and out day to day? And in many cases, there's been the ability of investors to get in and out on a regular basis, but the underlying assets, there's been this sort of duration mismatch where the underlying assets in a private equity fund are typically have a a life cycle of 7, 8, 9 years. So if you're invested in assets that have 7, 8, 9 year life cycles and the fund can't get out of them, but you let your investors come in and out every day, there's a real mismatch. And now because people are worried, they're heading for the exits, and the funds are forced to sort of put up these gates to protect the fund, really. And I guess, we're really going to have to see how this plays out.
And there's really no recourse, is there?
No, I mean, those are the terms. Each of these funds has different terms, but they're written into the offering memorandum or prospectus of the strategy. And the investors are, the fund has the ability to do this. And I think now some funds are even trying to strengthen those protections and allow more gating. And perhaps it's a good idea to protect the investors and not have a quote unquote run on the bank. But, I think ultimately, in our view, this is going to lead to, when those gates come down, a lot of redemptions in private funds and some of that money flowing back into public equity markets in Canada, which we think will be a good thing for public equities and public equity managers in the Canadian market.
That was Colin Stewart, CEO and portfolio manager at JC Clark. Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. Market Call is coming up next. Joining us today on Market Call is Brendan Caldwell. He's president and CEO of Caldwell Investment Management. His focus, North American large caps. And a quick look at how the markets are doing right now. The TSX rallying nicely again today, up by 1.1%. And south of the border, it's pretty much the same situation. Everybody in the green down there. That is it for Morning Markets. Thanks very much for joining us. We'll see you back here tomorrow. Have a great day.